I'm Tracy Kutzer, and I head up the institutional distribution team at STANLIB. And we're very excited to have you join us this morning as we discuss the levers the country has to ignite growth and, very positively speaking, get us back on the right track. So I'd like to start by introducing today's speakers. Firstly, the man we all love to listen to, STANLIB's chief economist, Kevin Lings. Morning, Kev.
Good morning, Trace.
Good. Then we're very fortunate today to be joined by Duncan Pieterse from National Treasury. I'm going to spend the rest of the introduction taking you through Duncan's CV because it's so impressive. I thought everyone has to hear it. But a few minutes just to introduce Duncan. Duncan is responsible for economic policy at National Treasury, where he's worked as an economist for the last 7 years. Duncan holds a PhD, master's, and Bachelor of Business Science degrees in economics from the University of Cape Town. And recently, very impressively, obtained a master's in public administration from Harvard University and has spent time at Yale and Brown universities as a research fellow. Welcome, Duncan, and thank you again for joining us today.
Morning, Tracy. Thanks for having me.
Great. And last but not least, Kholofelo Molewa, who is a portfolio manager in our private debt investment team at STANLIB. Kholo is also the co-portfolio manager on STANLIB's Kanisa Impact Investment Fund and will be sharing insights today on the exciting space of infrastructure investing in South Africa. Certainly a topic and subject that's taking up a lot of headlines and being spoken about a lot. So it'll be good to get your views, Kholo, on how there does not need to be a trade-off between investment return and impactful investments. Welcome, Kholo.
Morning, Tracy, and thank you.
Good. So hopefully that provides a good backdrop to today's session. I know I'm definitely looking forward to the dialogue and hearing Duncan's insights from behind the scenes. And I think there's a lot of armchair economists and a lot of armchair financial specialists on what the country should be doing. But fantastic to hear, Duncan, your views on exactly what levers we have and what is happening. So maybe just a few housekeeping points and then we can get straight into it. So the Q&A chat on the side is open for questions and we'd really love to hear from you. Make use of that. We've set aside some time at the end where Kholo, Duncan and Kev will all be available for questions. So we look forward to hearing your thoughts as well. Then CPD points. I know I see a lot of questions on this on the chat. Will be automatically allocated to you, but only if you stay to the end. So there's an incentive. And lastly, the session is recorded and will be available on the stanlib.com website. So please feel free to share that with your end clients or to go back and review anything which you'd like to listen to again. Good. So that's enough for me. I hope you enjoy the session. And over to you, Kev.
Thanks, Trace. Morning, everyone. All right, so let me give you some idea of what we're hoping to get this session. Obviously, I'm not going to go through a huge economic discussion, so I'm not going to put up a whole series of charts. What we decided to do was to try and get Duncan to join us, and I've heard Duncan a couple of times on various things, either on TV or webinar, and I must say Duncan has an ability to explain what's happening in government better than most people within government, I must say. So we're very pleased to have Duncan chat to us about what policy is about within National Treasury and I guess broadly within the government framework. So I'm going to have some question and answer discussion with Duncan and then Kholofelo will try and explain how that feeds into some of our investment views. And certainly from STANLIB's perspective, we're very excited about things like the infrastructure fund and some of the initiatives that government has put on the table in terms of policy, particularly recently the electricity framework that was announced. From our perspective, that's fairly encouraging. So I must say we've become much more optimistic about the outlook. Obviously, right now the economy remains under significant pressure. And the way I look at it is, South Africa's at a junction, at a critical junction. We've gone through a phase where there's been substantial deterioration. Economic growth has been under pressure for some time, and this year we're saying economic growth probably declined somewhere between 8.5% to 9%. If we look at fiscal position under enormous pressure, tax revenue has clearly going to be very disappointing relative to budget. The budget deficit is going to be double digits. Government debt is on the rise. We've had the credit rating downgrades, and I was listening to Moody's a couple of days ago, and Moody's was also saying, look, you know, we need to put South Africa on a better path, otherwise we run the risk of further downgrades. So that's clearly in the background. If we look at the unemployment environment, if you, just the data that came out yesterday showing 2.2 million jobs lost in the second quarter, that's a massive hit to the economy. And obviously we'll add some of those jobs back, but it's no doubt going to take a considerable time for South Africa to add back the 2.2 million jobs that we've lost. So we are at a junction. We need to put South Africa on a better path. The Minister of Finance, I think, has said that absolutely categorically, that the current fiscal path is unsustainable. And he put together what I thought was a very good chart to show the difference between what he calls the passive scenario and the active scenario. And if we're on the passive scenario, we do end up in an outright fiscal crisis. So I think there's much more awareness of the challenge ahead. The policy framework, I think, has been discussed extensively. There are various policy papers. I'll chat to Duncan about which policy papers we should be focusing on and which aspects of that. But I think it's quite important to get a sense of where National Treasury is at in all of this, because they play the pivotal role in directing where the economy ultimately goes. And they're in a position where they can listen to various government departments and understand their concerns. They can listen to offshore investors, and they understand what offshore investors want. And then they do listen to what the private sector has to have and cut through the criticism and say, well, we can understand the frustration from the private sector. So I think talking to National Treasury at this point in time, to me, makes a huge amount of sense. So thanks very much, Duncan. Thanks for taking your time out of your busy schedule to give us some insights. Can we perhaps just start with a general discussion, and that is, how would you describe the approach to fiscal policy at the moment from National Treasury? It's clear that the medium-term budget is going to have to announce some significant change in direction, and we're very close to that medium-term budget. So I understand that you can't talk about the specifics within that. It's just too sensitive at this stage. But perhaps if you can give us some insight as to the overall thinking about policy direction in terms of government expenditure, and then if you can switch to the concerns in the private sector around, well, this will all be funded through higher taxes, and that we're going to see this ever increasing tax burden in South Africa. What is the general thinking around where the tax burden is at the moment?
Okay, morning, Kevin, and to all your guests. Thanks for having me. So, I mean, when we start with fiscal policy, let's look at it, as you've said, in terms of the various components, right? Expenditure, taxes, and borrowing. And let's start with expenditure. So what we've said in this year's budget, as well as in the supplementary budget, that what we've seen is that we've seen a rise in government spending as a proportion of GDP over the last few years, let's say, from around 27% or so to about just over 30%. Those increases have been funded somewhat through higher taxes and also through greater borrowing, right? But we don't really have any growth outcomes to show for it. So at the same time, you have government expenditure increasing as a percentage of GDP, but you're not getting growth. And so the question is why, right? And I guess there are a couple of reasons why that's the case. And those reasons have brought us to what we announced in the supplementary budget, where we are saying that what we will need is a very different approach, one that requires a very large fiscal consolidation, mainly through expenditure reductions and some tax increases, and I'll talk about that in a bit more detail, because without that, we are on this sort of slippery slope to this passive scenario and what that looks like, and we articulated that. And I think there are a couple of reasons why this growth in government expenditure has not delivered the sort of economic outcomes that one would expect. The one is that we have these very binding structural constraints in the economy that makes it very difficult for any kind of government expenditure to have an impact. And those are well known. Electricity is a very good example, but there are others. Our skills constraint has been very well documented by academics and others, as they show this widening gap on the skills premium and the fact that we just don't have enough, skills to get the economy going. So there are these structural constraints, and at the same time, the composition of our spending also hasn't helped. So if your composition of spending over time shifts away from infrastructure and the supporting goods and services to enable service delivery and slowly towards wages and other types of consumption, then that means over time you are eroding the ability of your economy to grow. So that sort of gets one then to a point where you say, well, what is the corrective action you require? And we outlined that, and we called it the active scenario. We outlined that in the supplementary budget. And at that time, we spoke about fiscal consolidation of somewhere around 230 billion. And we spoke of some tax increases, very small actually. They were 5 billion next year, and then 10, 10, and 15, right? So those are very small tax increases. And actually, just as an aside, when we run those sort of tax increases through our macro model, you find that they don't actually move the lever either way. So that's where we are on the expenditure side. So moving to on the tax side, it's clear that we are constrained in our ability to increase taxes further. And we've spoken about that in the supplementary budget and previously. And there are a couple of reasons why. The one is that there are no obvious gaps in the tax system that we can target. And I'm talking about large gaps. We know that typically in a normal sort of economic cycle, a 1 percentage point increase in VAT gives you about 20 billion. That's what we did a few years ago. But those kinds of mechanisms that give you big once-off gains without a very hard impact on the economy just aren't there. The other thing that we're finding is that the evidence shows us that increasing marginal tax rates on high income earners in particular is also not going to give you much more revenue. We're fortunate that we get all the tax data anonymized from SARS. We've got a secure data lab here, and we've got a whole lot of researchers, academics and others going through that data, and that's a very clear finding from their work. And then finally, we also know that tax multipliers are quite high and negative. So that means that you increase taxes, the growth impact is negative and it's large. So that means you're really constrained on the tax side, and you can't really do much there. So that means the heavy lifting of a fiscal consolidation has to be carried by expenditure. And you have to do it in a manner that improves the composition of your spending. And so that means that you really have to target the elements that are not necessarily going to be contributing to long-run growth and protecting the important parts of your spending. And those are things like infrastructure budgets, social grants and so on. And that's the broad sort of guiding principle that's influencing how we are approaching MTBPS.
Okay, excellent, Duncan. I'm going to come back to the infrastructure discussion a little bit later. But when I looked at the supplementary budget, it's very clear that in order to move us into the active scenario, each government department is going to have to play their role. This burden can't be carried by one or two departments. Do you have a sense that there's the political will to do this? In other words, National Treasury is saying to the cabinet and to the broader government, guys, we've got to make some big changes here. National Treasury has articulated those changes, do you have a sense that each government department understands that and is willing to do the heavy lifting, and therefore this is not going to be a massive fight to try and eke out some consolidation of expenditure, and that it can be a more collegial process within government?
Yeah, I mean, I think any fiscal consolidation is always going to be politically difficult, right? Because you are asking departments to have a look at their budgets and make a contribution to the fiscal consolidation effort. I think what we find comfort in is that Cabinet has endorsed the active scenario, right? So Cabinet has said to us, we agree that these large reductions in our spending is the best way to restore fiscal sustainability. And I think that's a very important first step. I think what's going to be interesting is to see what exactly that looks like through the various processes that we engage, both provincially, nationally, and so on, in terms of the various budget processes that yield the final outcome on the 230 billion. Ideally, what we would like is a situation where the 230 billion is approached and achieved in a manner that improves the composition of our spending and therefore raises long-run growth and raises potential growth, right? And that is what we are pushing for, and that's what we have issued to departments in the what we call MTech guidelines, which are the guidelines that go out to each of the departments and say to them, this is what we need to achieve, and this is how we suggest you go about achieving it. And I think that's sort of where we are at the moment, and the final outcome of that will be revealed at the MTBPS.
Right, so you're in the process of that, and obviously you can't discuss the detail of that, and we'll get sight of that towards the end of October. But alongside of that discussion, I would imagine that there is a degree of concern, frustration from your guys' perspective that you've still got a range of state-owned enterprises that are not in the clear by any means. And I don't want to discuss SAA because I can understand the sensitivities around the additional financing of South African Airways. But if I look at the Post Office, if I look at Denel, you know, there are significant gaps within SOEs generally. So within this framework, what is the general approach then to assisting state-owned enterprises?
Yeah, I think and if you go back to our to the growth paper that the Treasury published and which was then endorsed by Cabinet and the government, which basically sets out the sort of structural reform agenda over the next few years, the first item we touched on there was modernizing and reforming our network industries, and that obviously means the state-owned companies that operate in those entities. Eskom, Transnet, Denel, and so on. And I think there are some state-owned companies that are clearly much bigger of a fiscal risk than others. And I think that's one way of looking at it. But at the same time, many of these smaller risks can very quickly add up in terms of the fiscal pressure that they exert. And I think that's why, in partnership with the Department of Public Enterprises, there's been this real concerted effort to say, at a state-owned company, at each of the state-owned companies, what are the specific reforms required on the governance side, on the regulatory side, and so on, to ensure that these state-owned companies are no longer a burden on the fiscus, which means on taxpayers, and can operate, appropriately, efficiently, and effectively. So I think for us, a lot of the work that we've been doing, especially in the last few months, is focused on, firstly, the regulatory environment that one needs in order to ensure that these companies can perform effectively. Secondly, it's about stabilizing those entities in terms of their boards, the senior leadership, and so on. We've had many meetings, for example, with the Eskom CEO recently, where we are getting regular updates about the efforts that they are undertaking to stabilize that entity, and so on and so forth. And I think it's only through this entity by entity approach, guided by some of the broader principles that you have in that growth paper, that says What are the regulatory changes you need? What are the coordination challenges you need to solve? How does one approach private sector participation in some of these sectors so that you can, over the long run, reduce their risk to the fiscus?
And Duncan, do you think we'll see the emergence of more restructuring of SOEs? By that I mean the inclusion of strategic equity partners within SOEs, maybe the breaking up of the entities and trying to deal with them in a different format? Or is it just about trying to fix the entity in its current format and then kind of see if it can get going from there?
No, I think if you look at what's on the table, you'll see that there clearly are attempts to also restructure. And let me give you a few examples. The Economic Regulation of Transport Bill, which is now going out for public comments and will hopefully be finalized in the next 6 months, is a mechanism by which one can start to introduce, for example, private sector participation in the freight rail sector, right? So it's difficult to do that without the regulatory environment that allows one, to do that. We have a regulatory environment in the port sector, for example, where the ports infrastructure business of Transnet is very well regulated by a very competent regulator, and that has allowed us to achieve not only efficiency gains on the infrastructure side. I'm not talking about the terminal operation side, but the infrastructure side, as well as gradual declines in pricing, improvements in the price environment there. Now, a lot of our other parts of our transport sector are not regulated. And so the first step is you need to establish independent regulation of those entities. And then you can then use that as the basis for encouraging private sector participation, which is certainly the intention of the Economic Regulation of Transport Bill. What's happening on the energy space, and maybe we'll get into this later, is another good example. The determinations that have been announced by the Minister of Minerals and Energy, as well as the RFPs that have gone out recently for private sector generation of electricity, mainly renewable, tells you that there are attempts at both shifting not only the energy mix, but also the players that contribute to the provision of electricity. So I don't think that it's about fixing the entities and retaining the status quo. It's about, it's about how does one create the right kind of market conditions for competitiveness, efficiency, productivity gains to be achieved, so that can then pass through to the rest of the economy.
Duncan, every time we've gone down that sort of discussion route with various SOEs, there tends to run into a conflict with the unions. At some point, there's a fear from the unions that this restructuring is going to result in massive job losses, and obviously there's a pushback. And we know that there's a pushback with wage agreements from government, with the unions, etc. What is your sense, without getting into the politics, and the politics gets messy here, but what is your sense of how unions are behaving towards the public sector? Has there been any shift in that approach? Has it eased? Is it still antagonistic? What is that relationship like at the moment?
I think the recent, I don't know how many of your guests are aware of the recent discussions that have been happening at NEDLAC around an economic recovery plan. And obviously NEDLAC is an institution that involves what we call the social partners, so businesses represented there, community, labor, and government. And we've had discussions on an economic recovery plan for the country, sort of looking at the post-COVID world over the last few weeks. And without getting into the details of the plan, I think one of the interesting aspects for me being part of those discussions has been seeing the union's commitment to resolving many of the issues that we have in our state-owned companies in particular. That was a very interesting area of agreement, I would say, both between business, government, and the unions, where the understanding is that the way in which these state-owned companies are both a burden to the fiscus, which means that they direct resources away from important social expenditure and infrastructure, as well as the manner in which they impact worker interests directly. If you look at something like PRASA, for example, and the implications that commuter rail has for COSATU's main constituencies, there are so many overlapping interests in getting the state-owned companies back on track, that I think that was a very interesting area of synergy. So my sense is that, and that'll be made clear when that document is released shortly, that certainly on state-owned companies, and in fact many other areas, there is a sense that partly because of COVID, in terms of how we respond, but also because of overall economic weakness, that is very important for all of us to pull in the same direction.
100%. I think the NETLAC document was definitely a breakthrough, and there are many elements to that. Obviously, there's a lack of detail on some of the areas, but I think the NETLAC document is a worthwhile document for people to have a look at and to see what has been agreed, certainly from the private sector's perspective, what has been agreed by the unions. So the last thing relating to government finance, Duncan, is municipalities. Now, I think most people will be surprised that National Treasury doesn't actually have that much influence on the municipal structure and how municipalities spend their money, etc. And clearly there are a number of municipalities that are problematic in terms of their financial deterioration. Is that element being addressed satisfactory, or do you think it's really work in progress and that the focus is more at the center, at getting central government finances more under control and then dealing with municipalities over time?
Yeah, no, we actually have an intergovernmental relations division at the Treasury, and their focus is on municipal finances in particular, but also service delivery. They've got a various programs, one of which is the City Support Program, which works directly with cities, mainly the metros, both on their finances as well as some of their technical, capacity in terms of service delivery. I think for me, the issue is twofold. Clearly, there are many municipalities around the country that are struggling. Our metros, which is obviously where the sort of economic heart of the economy lies, are faring a little bit better. And I actually think that there are many more opportunities for metros, for example, especially those whose finances are in a better state, to undertake much more of their own lending. And Treasury's been working with them on that to ensure that, again, the burden on the national taxpayer is relieved in favor of a situation where some of the stronger municipalities with better balance sheets can go to the market, access the kind of funding that they need to in order to drive infrastructure and maintenance program in their areas. So I think that there are opportunities in that area that one can explore in terms of how does one tap some of the untapped funding sources in that space, particularly at the metros. But certainly some of the municipalities, especially outside of the metros, are a concern, and we are working with them both on the financial side as well as on the technical capacity side.
Duncan, can we just turn our attention to growth initiatives, because obviously that's critical. We've got to lift the growth rate, we've got to create jobs, we've got to expand the tax base. There's all kinds of things that have to come together here. And when we look at the various policy documents and policy initiatives, out of all of that, and I'm not saying that there's not importance within many of those aspects, but out of all of that, the infrastructure initiative stands out for us as being particularly encouraging, partly because it's made gains already and it seems to be moving in the right direction, partly because the private sector seems to be endorsing it as an initiative, and partly because it makes a lot of economic sense in terms of a good way to grow this economy. Can you just put the infrastructure initiative within context? How does Treasury see that? Is it a critical building block? Is it an issue that Treasury is going to keep promoting? And is it making the gains that we envisage?
Yeah, I think I would say there are sort of two aspects of it, coming back to the beginning of our conversation. The one thing is about how do you get the composition of spending right and have a shift towards infrastructure, right? From a government spending point of view. And of course, that's one part of investment. I mean, you know, as you know, if you look at in gross fixed capital formation holistically from an economic perspective, about 70% of it sits with the private sector, and the other 30 is sort of split evenly between state-owned companies, mainly Eskom and Transnet, and other spheres of government. So if you look at the government component, I think a big part of it is how do you support infrastructure delivery by protecting infrastructure budgets, right? And making sure that your composition of spending shifts. I think that's one part of it, and that's something we spoke about at the beginning. The other part of it is how do you effectively crowd in private capital to support infrastructure investment? And I think we've certainly seen some movement in that space, and particularly in energy, and we can come back to that. But I think part of it is about how do we learn also from some of the successful initiatives we've had in the past. And the Renewable Energy Program is a very interesting initiative because you have a very structured way in which you can crowd in private sector capital, domestic and international, backed through government guarantees that sit as contingent liabilities on the national balance sheet, with a feed-in tariff that makes sense for the private sector. And so the idea is, how does one start to replicate some of that thinking in other parts of the system? And the work of the IPP office, which initially started focusing on energy only, how does one replicate that into other parts of the economy, whether that's wastewater management or whatever the case may be. And I think that's sort of where the discussion is at the moment, and certainly that discussion's happening between ourselves, the DBSA, which plays a big role on the project pipeline implementation side. The infrastructure office in the presidency, headed by Dr. Ramaghopa, is an important partner there. And it's about both of those things. It's about the funding and financing aspect from government side, as well as how do you shift the regulatory environment to crowd in private capital. And in that sense, what we've seen on the energy policy side has been very reassuring, because you've seen the 2,000 megawatts being issued for the RFP for that being issued. The RFP for the 12,000 megawatts of energy is coming, and that's been announced. You've got regulatory shifts that have happened in terms of embedded generation that's going to assist companies to self-generate, particularly under 1 megawatt, because the licensing requirements have been removed. Municipalities are being encouraged to buy directly from IPPs. That regulatory shift is underway. So all of these, the regulatory mechanisms that you need to crowd in private capital, those are clearly shifting. And I think those shifts are important in order for us to relieve the pressure on the state and Eskom, and to crowd in private capital in a sensible way.
Duncan, if you put your economist hat on and you kind of look forward, when do you think we would start to see evidence of this in terms of project implementation? Because obviously a lot of the discussions that we have with policymakers and government broadly, it really sounds convincing, but then it fails at the implementation stage. That's certainly been the recent history. When do you think we'll see some sort of sign of implementation with regards to infrastructure? By that I mean that becomes more visible to households, visible to business, where the sign, the showing of this infrastructure then can lift confidence. We know that during the Soccer World Cup, when you saw the stadiums going up and the cranes functioning, it did lift confidence. When do you think we might see that sort of thing?
Yeah, I think one has to almost separate energy from everything else. I mean, energy is a bit easier, right? We know that, for example, on the 2,000 megawatts, RFP is out, bidding will close in December, evaluation will begin, financial close is April next year, then construction starts in May. That's a sort of tried and tested method. We've been doing that for years. It's clear to see how that's going to play out, because we have a clear institutional mechanism there. On some of the other infrastructure projects, I think that certainly has become our focus. And if you look at what the minister's been saying around Operation Vulindlela and the joint work that's being done between the presidency and the Treasury around shifting the focus to implementation and learning some of the lessons from the delivery units around the world around how does one resolve some of the coordination challenges, technical challenges, capacity challenges that have seen us lose implementation credibility recently, and restore that. And I think, as I said, we've got lessons that we can learn from energy and apply that elsewhere. We are focusing on implementation at the moment, and I think that certainly will be something that'll start feeding through the system as this work gets going. So it's difficult to predict, obviously, when one will see the outcome of these things, but I think it's reassuring to see the shift to the focus on implementation. And I think certainly on the energy side, I think there's a lot underway that will start feeding into confidence and therefore investment very quickly.
Duncan, last question. I'm just concerned about time, and Kholofelo's got some very interesting stuff to chat about in terms of STANLIB's initiative. But just a last question. When you mention an infrastructure gets spoken about, etc., and you sit in my world, immediately people start to talk about a fear of changing Regulation 28. The word prescribed assets gets mentioned, etc. From your perspective, what is the thinking around a possible change in Regulation 28 of the Pension Fund Act?
Yeah, I think, Dr. Ramokgopa has spoken about this before because he gets asked this very often as the head of infrastructure in the presidency. What's your thinking? What do you think we should do? And I agree with what he said on this. And his views are simply that it is clear that with the right kind of regulatory change, you don't need Regulation 28 to be changed in order to crowd in private capital. And we know this because we've seen it in the renewable energy program, right? And so I think the question is, how does one learn from things like the renewable energy program, right? And it doesn't have to be the risk therefore sits with the state in terms of the contingent liability that underpins the program. There could be other innovative ways of crowding in private capital, guaranteeing feed-in tariffs, etc., etc. But it's clear that there are many other mechanisms to achieve the locking in of private capital in infrastructure investment than having to resort to Regulation 28.
Brilliant. Thanks, Duncan. Thanks for your insights. It's a fairly short section of time, but we really appreciate that. And hopefully we can have you back in the near future to explain particularly the upcoming tax cuts in a lot more detail. Duncan, you're going to hang around. We're going to listen to Kholofelo talk about STANLIB's initiatives around the funding of infrastructure, etc. And then hopefully we have some time at the end for some questions. So in the meantime, thanks a lot, and we'll chat again shortly. Over to you, Kholofelo.
Morning, Kevin, and morning to the listeners. I'm going to just share my screen. There we go. So I think the topic and the conversation that I'll touch on really segues from what Duncan and Kevin were speaking about. I'm focusing more specifically, though, on the role of private debt in helping facilitate at least some of the economic activity that speaks to a recovery. And our view is that we see it really as a collaboration between various stakeholders, namely being us, government, and other social partners that Duncan touched on, like labor, which is all very critical if we are going to pull in the same direction and have any semblance of recovery from this current malaise that we're in. So as Tracy introduced earlier, I'm part of a broader team within STANLIB, a team called Credit Alternatives. Our focus is on debt. And our history, really, we began in, I guess, very similar circumstances to what we're seeing today during the global financial crisis in 2009. And the thesis then is the thesis now, in the sense that we saw market dislocation, pricing mismatches, where our approach as a, I guess, very fundamental driven investor, we saw opportunities worth chasing and worth investing in. And where we are today really is that we manage 50 billion in assets, roughly 50 billion in assets. And we've had a continuous evolution as well, how we think about our role as an investor. And part of that evolution has involved thinking quite sharply around the idea of not just being a commercial investor, but certainly focusing on areas such as impact. And to that end, we launched earlier this year a fund called Khanyisa Impact Investment Fund, which, as the name suggests, is quite focused on making investments within the impact space, which covers infrastructure and other aspects as well. So just what's happened, and really continuing from where Kevin and Duncan left off, is that the global financial crisis and COVID combined, I mean, I think even pre-COVID, there was reduced fiscal space from government, from Treasury, in financing any type of economic recovery, just within the current fiscal budgets and frameworks. So the need has definitely emerged, and what this COVID-induced crisis has sharpened is that there is a need to mobilize private capital to finance that gap. And really a lot has been said about in the previous conversation around crowding in. Within a South African context, when we speak of private capital, or what we variously describe as alternative assets, we've got just under 3% of pension funds are allocated to this, broadly speaking, this asset class. And, you know, relatively, if you compare us to our international counterparts, we're looking at in excess of 25% here. So there's still a gap, and still, I think, an opportunity for those of us within the private sector to think quite deeply and carefully around how we mobilize. REAP was touched on, and I think REAP is an important thing worth highlighting on its own, because what it did is it really put praxis to the thesis around how government and the various stakeholders operate as well. REAP has been a massive undertaking, and we think when we think about how to engage government, how to engage government as a private debt investor within the recovery, we think that REAP actually showcases a template that can be modified and scaled into not just energy, but certainly even in other sectors and technologies. And I know that's the kind of conversation that the IIO has been having. What's interesting, though, is that when efficiencies are, I guess, when the waters recede and we're in a state of crisis, new social compacts maybe begin to emerge. And we've had a plethora of economic plans and ideas, specifically focusing on the recovery, I think within the last 3 months. So the ANC itself produced an economic recovery plan, which was quite comprehensive. The economic cluster within government itself produced something, National Treasury produced something, and I think most recently Business for South Africa produced also quite a comprehensive document in this regard. What's noticeable about these various strands of plans and documentation is that they speak in part, and perhaps this is maybe the optimist in me, they speak in part to probably an emerging consensus, an emerging thought around how to approach the relationship between business and government. And in fact, what's not here is the NEDLEC document, which, you know, as far as these things go, we thought was quite an interesting start. There's still some things to flesh out, but what it does speak to is this kind of collaboration effect that in some ways has been forced upon the various stakeholders as well. And what's in the middle of that really is this idea, that's settling as a given, that there is a definite role for private sector capital to play a role. So in our context, we think of it as private debt. And what I thought is that maybe just to highlight that, some people don't know what private debt is. Essentially, private debt is what instores or outside of the banking framework provide as financing into the market. It's not typically listed on an exchange, although it can be. And just given the nature of the asset class is that you can enter into bilaterals, you can enter into sort of consortium type funding. There's wide scope in how it's applied, and we finance into corporates, certainly into infrastructure, real estate, and very sort of bespoke project-based funding, and obviously securitization vehicles as well. What's a recent feature is taking all of that as well and underpinning that with a very impact or ESG lens, and which is why I mentioned our efforts into Khanyisa at the moment, the fund that we're rolling out. The nature of it is that given that it's bespoke, you can structure it in a myriad of ways. And this is relevant, we think, in having discussions with the state, whether it's the IIO or other elements of government or state-like entities as well. And why that's relevant is that we see the suitability of the asset class is that, there are a couple of things to highlight here, is that private debt allows for government to crowd in investments in a way that doesn't necessarily raise what could be a political hot potato around privatization. So in other words, you get the investment without necessarily the quid pro quo of ownership transferring. And that's been an engagement we've had with some government entities around that, around the role of debt. And that's an advantage we see because it speaks to the flexibility. We can tailor a funding approach in a way that's bespoke, that allocates risk accordingly, without ever entering necessarily into a conversation, at least in the first instance, that we are doing whole-scale privatization. I think if we went, it makes it a little bit more palatable in that sense. The finite nature of it as well allows us to sort of structure outcomes with a given outcome in mind from the beginning. So before we even put pen to paper, before we deploy, we're already thinking quite carefully around our various ways out. And that suits us, that suits, we think, government. And a good example of this, I would say, is around even, energy is being used quite a bit, but there's a couple of, say, PPPs that have been rolled out recently where massive private sector capital is coming off the sidelines, allowing government to effectively own the infrastructure, but allowing private sector to not only finance, but operate the infrastructure on what we typically call a build, own, transfer model, essentially. And it's kind of a win-win in that sense. It's not privatization. You can sell it to the unions. You can sell it to other stakeholders as well. So some of the low-hanging fruits have been discussed. Infrastructure is an obvious one, very topical, both economic and social infra. Energy, the Section 34 determinations, we're very happy to see those signed off recently, I think last week. Once again, just to reiterate, we think that's definitely a low-hanging fruit in the sense that there is a template there. The IPP office has got institutional memory, and we expect that to be operationalized, similar to what occurred in rounds 1 to 4 of the REAP program. Housing, big focus on housing around infrastructure and how we think about it, and that's coming on stream. Healthcare, especially given the current environment, the healthcare model is changing. Some of it includes telecoms. I mean, some of it includes PPP models and this kind of build, operate, transfer model that I described earlier. And telecoms. Telecoms is going to be a huge factor. We've seen quite a lot of activity there. Financial inclusion, agriculture, and an interesting one is township, this discussion around the township economy. I think some of you would have seen recently that the economic cluster issued a paper around that Gauteng is considering a bill or a regulatory framework around financing. It's a bit controversial given its requirement for local ownership, but some of the elements of that are quite interesting, and we expect that to marshal in private sector capital. And we're seeing that where government at a provincial level is starting to provide sort of first loss components as well. So the various forms in which we do it, we look at PPPs, blended finance, bonds, and as you know, PPPs have been around, I think, almost since the dawn of democracy. There's some changes that are being adopted to that, and we expect that once the modifications occur, we expect that to be quite a critical funding vehicle in terms of how it manages risk. I mean, there's been delays and complexities, but I know that there's efforts to optimize that. Blended finance is a big factor, and blended finance speaks to this collaboration. By nature, it involves both commercial capital and concession type capital, which can include government as well, and it helps optimize our capital structure. Bonds are self-explanatory, so I'll gloss over that, but project bonds, CPI-linked bonds, a lot of work in Treasury around specifically infrastructure, looking at green bonds and financing infra bonds specifically. And just to sort of maybe rounding off as well, I mean, yeah, collaboration, there's components here that we've spoken a lot about collaboration, but innovation is quite key. The nature of private debt allows for innovation. South Africa is quite a pioneer in sort of the green bond space, believe it or not. And I think we expect that to cascade. Sustainability is key in all the discussions that we're having with government around collaboration and funding as well. And, you know, impact and ESG are key considerations, and not just the standalone fetishized concepts, but as part of the overall investment thesis. And risk management. We live in a risk-on environment where we accept that risk will never go away, and it's really managing risk. And I think the best investment managers in the space will always have risk as the foreground, irrespective of the asset class. The IIO we spoke about a little bit, and Duncan and Kevin touched on. So the gazetted projects, there are 50 of them, total of 340 billion, and it's across energy. I mentioned that housing is a big focus, so you'll notice that actually the bulk of it is actually around housing, transport, water, sanitation. What's different now really is that the IIO, presidency, Treasury, DBSA, I have implemented, I guess, fast-track mechanisms around regulations, and regulations that have traditionally hampered involvement of private sector capital. There's a lot of activity around that, which we view overall as positive. We've spoken about the Section 38 determinations as well, which is going to be a big starting point. So yeah, in conclusion, I think your current economic challenges present an opportunity not to sort of make too fine a point around that, but certainly a recognition that the only way out of this crisis is for us to all collaborate on some given basis, and all social stakeholders. We see private debt as an ideal asset class. It can be customized. It can meet the needs of not only investors on the one hand, but certainly even government related entities on the other hand. And a key advantage, just to reiterate, yeah, we see it as kind of an optimal thing where we can provide capital without ever having to have the debate around privatization, wherever you are on the spectrum on the merits of that. It's a scalable asset class, and you know, we need scale in this market. We can marshal private sector capital through pension funds and other markets as well. And you know, it's a growing trend as well. And I'll leave it there. Thanks, Kevin.
Thanks a lot, Kholofelo. Tracy's going to join us and go through some of the questions that are in the background. Thanks, Trace.
Super. Thanks, Kevin, Kholo, and Duncan. That was, I mean, for me, I think, you can be surrounded by so much negativity every day and focus on what doesn't work in South Africa and where the blockages are. And I can see there's a lot of passion definitely coming through in the questions about what isn't working. But Kholo, I think the points you touched on, and Duncan, the positive message that you gave us, certainly very encouraging to think what is working and what is being done, and that I think everyone at least is on the same page now. Whether we've been forced to get there by COVID or whether it's the fiscal position the country finds itself in, there certainly seems like all the minds are focused in the right places. So thank you for that positive message on a Wednesday. Good. Duncan, maybe a question for you that came through quite early on in the chat is obviously the foreign disinvestment which we've seen out of our bond and equity markets year to date. It's quite a staggering number, and whether that's specifically South Africa or just the risk backdrop in total. But what do you think initiatives, or is there anything in place to try and attract that investment back to SA? How are we rebuilding confidence, and what messages are we sending to foreign investors to try and get that capital back into our bond market? Obviously critical for the success of any country to attract that investment.
Yeah, thanks, Tracy. I mean, it's something obviously that we look at very closely at the Treasury. I think foreign holdings are now down to 29% or so based on the latest data, which is close to where it was in 2011. And a lot of that, in our assessment, has got to do with the fiscal risks and why it's so important for us to have the kind of fiscal consolidation that we spoke about in the supplementary budget. If you look at the steepness of our yield curve, you can see that what the SARB has done has managed to lower the short end of the curve, but the risk premium developments, as well as what we're seeing on CDS spreads, obviously feeds into the long end of the curve. And the steepness of that long end tells us that investors are concerned about fiscal sustainability. And that obviously is about fiscal policy as well as economic policy, because you have to look at the denominator as well when you're looking at debt to GDP. But I think our view is that to the extent that one can put forward a credible fiscal consolidation that stabilizes debt to GDP, that improves the composition of spending, you will then start seeing that feed through into the risk premium as well as into CDS spreads. And then hopefully you'll see that the steepness of the curve flattening over time. And of course, that then feeds through into debt service costs and in our ability to allocate spending more effectively.
Thanks, Duncan. Maybe another question, either Kevin or Duncan, and I know it's quite a sensitive subject, but one of our clients is asking, like, is privatization of inefficient sectors not the silver bullet? Whether it's electricity, airlines, etc., kind of hitting two birds with one stone in terms of lowering the outgoing fiscal expenditure burden and simultaneously rising once-off capital windfalls. I mean, is sort of thinking shifting at all, or is that still a sensitive subject?
From my perspective, I think the restructuring of SOEs is as close to privatization as government is willing to get at the moment. That doesn't mean that down the line you won't see greater private sector involvement in some aspects of the public sector. And from what I understand, the infrastructure rollout has to involve the private sector in some way or other. There's a recognition, I think, that this can't be funded at a central level. It's going to have to crowd in the private sector. And I see that as an element of privatization. And I think that that's probably appropriate within the South African context. The typical classical privatization, we take a state asset, we sell it. I'm not sure that that is a model that is likely to be pursued. I think there are other mechanisms that are currently underway. Duncan, I don't know if you want to add anything to that.
Not really, Kevin. I mean, I agree with you. I think privatization exists on a spectrum from full sale of an asset to some form of private sector participation. And I think in some sectors it may be appropriate, and in others it may not be. You may not want a fully privately owned transmissions grid, for example, or fully privately owned railway network, but you certainly want private participation. And I think it's about achieving the right balance on a sector-by-sector basis about what type of private participation is appropriate. And in areas where the state has no business being there, some form of full privatization probably is appropriate, but in others you'll have varying degrees of private sector participation.
Thanks, Duncan. And I know we're running out of time, but maybe just one quick last question, because I think it will be nice to end on a positive note. But Kholo, one of the questions is, what is the REAP? And whilst I tried to answer that, explaining that it was a renewable energy project between government and the private sector, maybe if you can just give us a quick summary of that, because it was such an incredible success story and something which I think we can leverage and really learn from.
Kholofelo, are you able to answer that? I think Tracy's disappeared. I think we've... Kholofelo, are you there?
Yeah, I'm back.
Hi, we can hear you.
I was saying that, yeah, sorry, the REAP is a program. It stands for the Renewable Energy Independent Power Producer Procurement Program, lots of P's there. And it was a program initiated in 2011, which was really a formalization of introducing new power outside of the ESCOM framework. And it was done over successive rounds up to round 4. We've been waiting for round 5, which we expect next year in Q1, Q2. And what the REAP does is that really it formalized crowding in of private sector capital, as Duncan explained earlier, where government has a role in 2 senses broadly. I'm simplifying, but where ESCOM is the buyer of the energy on the one hand, and where Treasury back-ends and provides guarantees to make the investments financially viable. We think it's a template worth revisiting for other sectors, not just in the infrastructure space as well.
Fantastic. Thanks, Kholo.
Thanks, Tracy.
I think Zoom kicked me out. I think my husband wishes I had an off button like that as well, but I'm nervous it's going to happen again. So I think we've come to the end of today's session, and I'd just like to thank you all. That was really incredibly interesting to listen to, and as I say, very positive for a change. So thank you. Good. We'll wait for another dose of realism on Monday morning, Kev.
Thanks a lot, Tracy.
Take care, everyone, and thank you again for joining us.
Yeah.
All the best. Bye.
Thank you.
Thanks a lot, guys.